and in this options trading strategies video, we're going to talk about covered put positions. Now, the covered put position is exactly the opposite of a covered call, as a covered call consists of buying 100 shares of stock and selling a call option against that. So a covered put position is actually a short stock position with a short put against it. So let's go ahead and talk about the general strategy characteristics of a covered put. So covered put writing is a strategy that consists of selling a put option against a short stock position of 100 shares. Now, the maximum profit potential of a covered put position is the share sale price plus the put credit minus the short put strike price times 100. Now, the maximum loss potential is unlimited for this strategy since we have a short stock position and nothing to mitigate the losses on the upside. Now, the expiration break-even price is going to be the share sale price plus the put credit. So since we're collecting a credit for the put, the stock price can actually increase slightly and we can still break even or not lose money. So the estimated probability of profit for a covered put is greater than 50%, and that assumes the stock and put are sold at the same exact time. Now, since that you're collecting a credit for selling the put, that increases your break-even price and allows for some upside room before losing money. So the resulting position after expiration is going to be nothing if the stock price is below the short put, because if the stock price is below the short put at expiration, you're essentially going to be buying 100 shares of stock at the put strike price, and since you're already short 100 shares of stock, you're essentially just covering your short shares. Now, if the stock price is above the short put strike at expiration, then the short put will expire worthless. You'll keep the premium that you receive for selling the put, and you'll continue to hold your short stock position. Now, in regards to assignment risk, if the short put is in the money before expiration, the assignment risk is plus 100 shares of stock per short put contract, and since you're already short 100 shares of stock, being assigned on the short put is essentially the same thing as just covering your short shares. So let's go ahead and look at a actual covered put example and look at the expiration risk profile graph. So here we have various strike prices and we have corresponding put prices for each strike. So at the time of these option prices, let's say the stock price is trading for $90 and we short 100 shares of stock for $90 a share. Now at the same time, we're going to sell the 85 put for a $3 credit. So the stock price is at $90 when we short 100 shares, and we decide we want to create a covered put position, so we're going to sell the 85 call for a $3 credit. Let's go ahead and take a look at the expiration risk profile graph for this position. So in this graph, we're just comparing the profit and loss potential of the short stock position and the profit and loss potential of the covered put position. So in this case, we can see that if the stock price decreases significantly, the covered put will perform less favorably than the short stock position, and that's because the covered put has limited profit potential. So in this case, the maximum profit potential of this covered put position is $800. Now, if the stock price drops to $50, we can see that the short stock position will be up as much as $4,000. So a short stock position is more aggressive than a covered put position, but where the covered put position really shines is if the stock price remains the same or even increases. So let's say the stock price remains at $90 through expiration. So if you recall, we sold 100 shares of stock at $90 and then we sold the 85 put for a $3 credit. So if the stock price remains right at $90 through expiration, the short stock position by itself will not make any money, will not lose any money, but the covered put position will actually profit by $300. Now that's because that short 85 put will expire worthless and we'll keep the $3 premium from the put and we'll have no losses on our short stock position. So if the stock price remains flat, a covered put position will do better than a short stock position. Now if the stock price increases, we can see that the stock price can actually increase as much as $3 before losing any money on the covered put position. Now that's because if the stock price rises to $93, we'll have a $3 loss per share on the short stock position, but we'll have a $3 gain from that short 85 put expiring worthless. So at $93, the profits from the short put will offset the losses from the short stock, in which case we'll break even. Now if you look at the short stock position by itself, it will be down around $300 if the stock price rises to 93. Now in the same vein, if you see that the stock price increases significantly, the covered put still does better than the short stock position because at any price above $75 or $85, that short 85 put will expire worthless, which will offset the losses on the short stock position. So, to make a long story short, if the stock price remains the same, decreases slightly, or increases, a covered put will do better than short stock. And the only time a short stock position will do better than a covered put is if the stock price decreases significantly. So now that you've seen the general characteristics of the covered put strategy and you've seen an expiration risk profile graph, let's go ahead and look at some real covered put positions to show you how the position performs through time as the stock price is changing. So here's the setup of the first trade. So the initial stock price is $50.47, and we're going to sell 100 shares of stock for $50.47, and we're also going to sell the 47 put expiring in 44 days. So for that short 47 put, we're going to collect a credit of $2.03. Now that brings our break-even price of this strategy to $50.47 plus 203, which comes out to $52.50. So the stock price can increase to $52.50 and we still won't lose any money on the strategy. Now our maximum profit potential is the share sale price of $50.47 plus the credit of 203 minus the short put strike price of 47 times 100, which comes out to $550. So the most we can make is $550. Now, of course, the maximum loss potential is unlimited because the stock price can rise indefinitely, in which case we will have significant losses on the upside. So let's go ahead and take a look at what happens to this position through time. So as we can see here, the stock price starts right around $50 and our break-even price is $52.50. So as we can see, the stock kind of meanders between $50 and $52.50, but with around 16 or 17 days to expiration, the stock price collapses from $52.50 all the way down to around $37.50. So a significant decrease in the stock price. Now on the bottom part of the graph, we're looking at the profit and loss of the covered put position and the short stock position by itself. So as mentioned earlier, when the stock price decreases significantly, a short stock position will outperform a covered put position. So in this case, as the stock price collapses through the short put strike price of $47, we can see that the covered put position reaches a profit of around $550, and that's because that's the maximum profit of this position. Now if you look at the short stock position, you'll notice that the short stock position reaches a profit of greater than $1,250. And that's because a short stock position has significantly more profit potential than a covered put because we do not cap the profit potential by selling a put. So in this instance, the stock price decreased significantly and the short stock position by itself did better than the covered put. So in this next example, we're going to look at a covered put position versus a short stock position as the stock price is increasing steadily. So here's the setup. The initial stock price that we're selling shares at is $114.88, and to complete the covered put position, we're going to sell the 112 put expiring in 46 days. Now we're going to collect a $5.02 credit for that put, which brings our break-even price to $119.90. So that's the share sale price of $114.88 plus the put credit of $5.02, which comes out to $119.90. Now the maximum profit potential in this case is $790, which is the $119.90 effective share sale price minus the short put strike price of $112 times 100, which comes out to $790. Now as always, the maximum loss potential of the covered put strategy is unlimited. So let's go ahead and take a look at what happens as the stock price is changing through time. So in this example, we can see that the stock price starts around 115 and it kind of remains range bound through the expiration of the short put. Now at expiration, the stock price is just below the break even of $119.90, and in which case we have a small profit on the covered put position. So as we can see here, the short stock position by itself actually lost around $500, and that's because the stock price increased almost $5 from the short sale price. So in this case, the short stock position did not do well because the stock price increased from the price where we shorted shares. Now, since we collected a $5 premium for the covered put, we actually broke even on this strategy despite the fact that the stock price increased through expiration. So this just shows that if the stock price increases gradually and not significantly, a covered put position will outperform a short stock position, and in this case, the covered put position did not even lose any money because the stock price was just below the break-even price at expiration. So this just shows how a covered put can give you some protection on the upside if the stock price does increase after you short the shares of stock and sell the put. Alright, so in this last example, we're going to look at a covered put gone wrong. So here is the setup. The initial stock price that we're selling shares at is $162.60, and we're going to sell the 140 put that expires in 42 days. Now for that 140 put, we're going to collect a credit of $6.72. That brings our break-even stock price to $162.60 plus $6.72, which comes out to $169.32. Now the maximum profit potential is going to be $169.32 minus 140 times 100, which comes out to $2,932. Now, as always, the maximum loss potential is unlimited because there's no limit to how much a stock price can increase. So let's go ahead and take a look at how this position performed through time. Alright, so as we can see here, this was an unfortunate position because right after we initiated the covered put position, the stock price took off. So the stock price was right around $160 at the beginning of the trade, and by the end of the trade, the stock price was around $230. So in this case, the stock price increased significantly. Now on the bottom part of the graph, we can see the performance of the covered put position and the short stock position by itself. So as we talked about earlier, at any price above the short stock sale price, a covered put position will outperform a short stock position because the profits of that short put will offset the losses on the short stock position. So as we can see here, as the stock price increases significantly, we have losses on both the short stock position and the covered put position, but since we collected some credit for that short put and the short put expired worthless, that offset the losses on the short stock position. So in this case, when you compare the covered put to just a short stock position by itself, the covered put does better because the profit from that short put helps offset the losses on the short stock position. Alright, so now that you know how the covered put strategy works, let's go ahead and talk about how you can select a put strike to sell based on your outlook for the stock. So the first thing you need to determine is, do you think the stock is going to rise significantly, remain flat, or decline slightly, or do you think it will fall significantly? So if you think the share price will rise significantly, then the covered put strategy is not the right strategy because it is a bearish strategy, and if you think the share price will rise significantly, you should be putting on a bullish strategy. So if you have a significantly bullish outlook, the covered put is not the right strategy. So outlook number 2, let's say you think the share price will remain relatively flat or decline slightly. Now I would say this is the most common outlook for setting up a covered put position because if you'll recall, a covered put position can profit if the stock price remains flat, declines slightly, or even increases slightly. So when you put on a covered put position, you're not really putting on a extremely bearish position like just shorting stock would be. So let's say you think the share price will remain relatively flat or decline slightly. So with a neutral to bearish outlook, selling puts with strike prices closer to the stock price, which would mean a 40 to 50 delta put, may be logical because when you sell a put with a strike price closer to the current stock price, you're going to collect a larger credit, which will give you more profit potential if the stock price remains flat and will provide you with the most upside protection if the stock price increases slightly. So if you think the share price will remain relatively flat or decline slightly, you might want to sell a put with a strike price closer to the stock price. Now outlook number 3, if you think the share price will fall significantly, you may not even want to sell a put against the short stock position at all because, as we've seen, when the stock price falls significantly, a short stock position by itself will outperform the covered put. However, if you insist on selling a put against the short shares, since you have a pretty bearish outlook for the stock, you might want to sell a put with a further strike price. So that could be anywhere from a 15 delta to a 20 delta put. So all you need to keep in mind is that when approaching a covered put, there's no one size fits all approach, and the put you sell will depend entirely on your outlook for the stock over that time period of the short put. So just keep that in mind. Alright, so let's go ahead and recap the summary of main concepts from this video. So first of all, covered put writing is a bearish strategy that consists of shorting at least 100 shares of stock and selling a put option against those shares. Now the strategy has less risk than a short stock position, but also less profit potential if the stock price decreases significantly. Now on a stock that remains relatively flat or increases, a covered put will outperform a short stock position, and that's because the profits from the short put will help offset the losses from the short stock position. Now to close a covered put position, you can simultaneously buy back the short shares and the short put, and by doing so you'll lock in any profits or losses that you have at the time. Now lastly, if the short put is in the money, a covered put writer may be assigned on the short put, effectively buying back their short shares at the put strike price. So if you're assigned on the short put, you're going to realize the maximum profit potential on the strategy, but you'll no longer have your short stock. So just keep that in mind, and if you don't want to be assigned on the short put, you'll have to buy it back before expiration. Now just keep in mind that if your short put is in the money, you're really not at high risk of being assigned until the short put has very little extrinsic value.